The dollar defense. Why everything you've heard about currency collapse is wrong. Everyone's talking about the death of the dollar. YouTube is flooded with videos screaming about petrodollar collapse, hyperinflation, and the end of American economic dominance. Bitcoin bros, gold bugs, and doom prophets all agree. The dollar is finished. There's just one problem. They've been saying this for 40 years, and they've been wrong every single time. I've spent 20 years studying monetary history, and the pattern I see isn't collapse. It's consolidation. The dollar isn't dying, it's evolving. And the very forces that skeptics claim will destroy it might actually make it stronger. Let me show you why. First, the petrodollar myth. You've heard that some magical 1904 agreement just expired, and Saudi Arabia is pricing oil in yuan. Here's reality. There was never a formal petrodollar treaty with an expiration date. What existed was evolving security and economic relationships between the US and Saudi Arabia through multiple agreements over decades. And Saudi Arabia still prices the vast majority of its oil in dollars. So does nearly every major producer. Why? Network effects. Imagine you're a Japanese company buying Saudi oil. You could theoretically pay in yen, yuan, euros, or any other currency. But here's the practical problem that no geopolitical maneuvering can solve. What is Saudi Arabia going to do with yen? They can't pay their workers in yen. Workers want reals for local expenses. They can't buy American weapon systems in yen. Boeing and Lockheed Martin want dollars. They can't invest efficiently in global markets in yen. The deepest, most liquid markets are dollar-denominated. They can't pay their contractors, suppliers, and service providers in yen unless those entities happen to have Japanese expenses. What they need is a currency that's accepted everywhere, that's liquid in massive volumes, that can be converted instantly into any other currency, and that's backed by deep, transparent, and reliable financial markets. There's only one currency in the world that fits all those criteria simultaneously: the US dollar. This isn't American propaganda or military intimidation. It's mathematical reality embedded in the structure of global markets. The dollar represents 88% of all foreign exchange transactions worldwide. Not 50, not 60, 88%. And here's why that number is so sticky. Every other currency in the world is primarily traded against the dollar. If you want to convert Thai baht to Brazilian real, you don't find a direct baht real market. Those markets barely exist and have no liquidity. Instead, you convert baht to dollars, then dollars to real. Two transactions instead of one, but the spreads are tighter and the liquidity is vastly better. The dollar is the hub of the global currency system. Everything else is a spoke, and changing that architecture doesn't just require countries to agree to use a different currency. It requires rebuilding the entire infrastructure of global finance from the ground up. Every pricing system, every trading platform, every bank's internal systems, every contract template, every accounting standard. The switching costs are astronomical. And who bears those costs? Everyone except the US, which is exactly why it hasn't happened and won't happen quickly. Now, de-dollarization is real, just not how fearmongers describe it. Yes, central banks are diversifying. The dollar's reserve share declined from 1% in 2000 to 58% today. But 58% is still overwhelming majority. The euro is second at 20, stuck there for 15 years. The yuan is barely 3% despite China being the world's second largest economy. When the British pound lost reserve status after World War II, it dropped from 6% to under 10 in 25 years. That's collapse. The dollar's movement over 24 years is adjustment, and it's slowing. The factor skeptics claim will destroy the dollar might strengthen it. American debt stands at $36 trillion, yes. But debt only matters if creditors lose confidence. And global creditor behavior suggests the opposite. US Treasury yields have remained stable despite mounting debt. During COVID, when the US borrowed trillions, yields barely moved. Why? In crisis, global capital runs toward US debt, not away. The Treasury paradox: the worse things get globally, the more attractive US debt becomes. March 2020, COVID hits, capital pours into treasuries. 2022, Ukraine war, energy prices spike, capital pours into treasuries. 2023, banking crises threaten Europe, capital pours into treasuries. Every crisis proves the pattern. Fear rises, money flows to safety. Safety means US government debt. This creates a reinforcing cycle that makes debt more sustainable, not less. China's reducing treasury holdings, developing the yuan, building BRICS alliances, creating payment systems that bypass SWIFT. On the surface, this looks threatening. But here's the fundamental constraint that no amount of political will can overcome: the impossible trinity of international economics. You cannot simultaneously have a controlled exchange rate, free capital movement, and independent monetary policy. It's mathematically impossible. Every country must choose two of these three. China chooses exchange rate control and monetary independence. This means they must restrict capital movement, and that restriction makes the yuan fundamentally unusable as a global reserve currency. Think about what reserve currency status actually requires. It requires that anyone, anywhere in the world can easily buy and sell large amounts of the currency without restriction. It requires that capital can flow in and out freely based on market conditions. It requires transparent, enforceable rule of law in financial markets that protects even foreign investors against arbitrary government action. China cannot offer any of this without giving up control of their exchange rate and their monetary policy. And giving up that control would threaten the entire Chinese economic model, which depends critically on managing the yuan's value to support export competitiveness and prevent destabilizing capital flows. This isn't a policy choice that might change. It's a structural trap. The Chinese government understands this perfectly well. Their careful, gradual approach to yuan internationalization reflects this understanding. They're trying to have it both ways to gain some of the benefits of reserve currency status while maintaining control. But you can't have it both ways. The math doesn't work. And here's the evidence. Despite massive efforts, yuan internationalization has stalled. After a decade of initiatives, the yuan still represents less than 3% of global reserves. Major central banks aren't accumulating yuan. Global businesses aren't shifting to yuan invoicing except in very specific bilateral China trade. The market is voting with its actions, and the vote is clear. Same logic applies to every dollar alternative. The euro lacks unified fiscal policy, mechanism for common debt at scale, plagued by political divisions. 25 years old, reserve share hasn't grown. Gold can't work in digital economy. Cryptocurrencies too volatile, lack legal infrastructure. The dollar will likely strengthen because there is no viable alternative, and in the next decade this will become more apparent. The global economy is fragmenting. Trade wars, pandemic disruptions, geopolitical tensions are breaking supply chains, creating regional blocks. Fragmentation creates uncertainty. Uncertainty drives demand for safe assets. What's safest? Dollar-denominated debt backed by the world's largest economy, deepest markets, most powerful military. Fragmentation creates currency volatility. As trade shifts and currencies fluctuate, businesses need stable units of account for multi-jurisdiction contracts. That's what the dollar provides. Concrete example: Vietnamese manufacturer sells electronics to Brazilian retailer with Malaysian components and Mexican assembly. What currency for contracts? Local currency basket creates massive exchange rate risk and complexity. Or use dollars, which everyone accepts and prices. The more complex global trade becomes, the more valuable dollar simplification becomes. American innovation continues dominating cutting-edge technology. AI, quantum computing, biotechnology, advanced semiconductors. This matters because technological leadership creates capital inflows. Global investors want exposure to American tech. Venture capital flows to Silicon Valley. Top AI researchers want American universities and companies. All requires dollars. Unlike commodity exports disrupted by discoveries or substitutes, technological innovation is self-reinforcing. Success breeds investment breeds success. The dollar benefits from this cycle. America's energy revolution gets ignored. The U.S. is now the world's largest oil and gas producer. We've gone from Middle Eastern dependency to net exporter. This changes balance of payments and reduces historical vulnerability. Energy independence means less exposure to oil shocks, ability to impose sanctions without self-harm, improved trade balance. All supports currency strength. I'm not claiming the dollar lasts forever. History shows no reserve currency does. Spanish dollar, Dutch guilder, British pound all declined. The American dollar will too, eventually. But timeline matters enormously. The British pound took 70 years transitioning from dominance to secondary status, driven by 2 world wars that bankrupted Britain. Clear successor in the United States, fundamental shifts in economic geography. None of those conditions exist today. America isn't fighting existential wars. No clear successor with necessary attributes. And while economic power shifts, the gap between US financial market depth and everyone else is widening. The NYSE has market capitalization over $25 trillion, larger than the next 5 exchanges combined. US corporate bond market, $10 trillion. Treasury market, $26 trillion. These markets provide liquidity at scale that doesn't exist anywhere else. Moving $10 billion quickly in US markets barely impacts prices. Try that in yuan. Market impact would be enormous. This liquidity advantage is nearly impossible to replicate. American legal and institutional strength matters. Yes, political polarization. Yes, congressional dysfunction. But independent courts, enforceable contracts, transparent accounting, property rights protected against government seizure. When Chinese companies or Russian oligarchs want to park wealth safely, where? Not yuan or rubles their governments can confiscate or devalue. They buy US real estate, stocks, bonds. American institutions, despite flaws, protect property better than anywhere. Demographics favor the US, better trends than any major developed economy. Population still growing through immigration. Higher birth rate than Europe, Japan, China. Economy continues expanding while others face population decline. China's working age population already shrinking. Japan's declining for decades. Europe faces similar challenges. Shrinking workforce means slower growth, harder to support debt, undermines currency confidence. America doesn't face this to the same degree. Demographic trends are slow and predictable. Decades-long picture favors the United States. The dollar's dominance isn't about American virtue or cosmic right to print world money. It's network effects, market liquidity, legal infrastructure, and absence of viable alternatives. These don't change quickly. They're structural. When I hear collapse predictions, I ask, collapse to what? UN with capital controls? Euro without fiscal union? Gold in digital economy? Cryptocurrency with no legal foundation? None make sense. The next major crisis will likely strengthen the dollar. When fear spikes, capital seeks safety. Safety still means US Treasury bonds. Investors positioned for dollar collapse over 20 years have lost money. Those betting on continued strength have done well. Not propaganda or conspiracy. Fundamental factors supporting the dollar remain intact. Should you diversify assets? Of course. International exposure, hard assets, protection against scenarios. Absolutely. Prudent portfolio management. But liquidate dollar holdings because YouTube says hyperinflation is inevitable? Assume American currency becomes worthless? Make dramatic decisions based on apocalyptic predictions wrong for 40 years? I don't think so. The dollar death story makes compelling content. It generates clicks, sells newsletters, moves gold and Bitcoin. Fear is an incredibly effective marketing tool. Tell someone their savings will become worthless and they'll pay attention. Tell them there's a simple solution and they'll reach for their wallet. But compelling narratives aren't always accurate narratives. Sometimes the boring, unsexy truth is simply this. The dollar remains the dominant global currency because the fundamental conditions that created that dominance haven't changed. In many critical ways, they've actually strengthened. The depth of American capital markets has increased, not decreased. The technological advantage of American companies has widened, not narrowed. The legal protections that make US assets attractive have been tested and proven resilient. The energy independence that seemed impossible 20 years ago is now reality. These aren't minor details. They're structural foundations that don't erode overnight. They don't disappear because of YouTube videos or Twitter threads or even legitimate policy concerns. They represent decades of accumulated institutional development that would take decades to replicate elsewhere. Could I be wrong? Of course, I'm a historian, not a prophet. Markets can be irrational longer than anyone can stay solvent. Politics can be destructive beyond what models predict. Black swan events can upend everything we think we understand. Unforeseen technological disruptions could change the game entirely. But I'm betting on structure over speculation, on mathematics over mythology, on historical patterns over hysterical predictions. I'm betting on the demonstrated resilience of network effects, on the proven difficulty of building alternative systems, on the observable behavior of rational actors making calculated decisions. The dollar was pronounced dead after Nixon closed the gold window in the NES. When Japan seemed unstoppable in the 1980s, experts predicted the yen. When the euro launched in the 2000s, experts claimed a new era. After the 2008 crisis, experts said confidence was shattered forever. Every single time wrong. Every time the dollar adapted and endured. Maybe this time is different. Maybe the pattern breaks, or maybe the dollar's position is more resilient than pessimists believe. Network effects stronger, alternatives weaker, path dependency more powerful than dramatic predictions acknowledge. Big changes take longer than you think, happen for different reasons than you expect, rarely look like disaster scenarios populating financial media. The death of the dollar makes great theater, but great theater isn't good analysis. Next time you see imminent collapse predictions, ask, what's their track record? What are they selling? What do they ignore? What does actual data show past rhetoric? Understanding currency markets isn't choosing sides or rooting for outcomes. It's recognizing patterns, understanding incentives, respecting the difference between what might happen and what will happen. The dollar might not last forever, but betting on its imminent demise has been a losing trade for half a century. I wouldn't bet against it now.